Good afternoon, welcome to Market Wrap number 159. Stuart Williamson here at the helm. Now, why do we do this? To share with time-short investors, property researchers, news and information on what is occurring in the UK market. Lesson learned from last week, inheritance tax is not something people are interested in, so I apologise for that. But what a week this has been though. Okay, gilt yields up, mortgage affordability in doubt, stories of residential property market crashes. What I recently saw was soaring mortgage rates, high inflation, rising cost of living, mass UK house repossessions on the horizon. So are, the UK's beleaguered mortgage borrowers likely to escape a scale of the home repossessions suffered in the previous economic crises of 2008 onwards? Or will they be punished with a 50% house price fall, as suggested by some? Will they have repossessions coming out of their ears, as people have suggested? We're just going to have a quick look at this now and see what our views are. A lot of this information was taken from the Financial Times report that came out recently, about this week. So thank you for that, FT. With 1.4 million households about to roll off their fixed rate mortgages over the course of 2023, most taken out 2 to 5 years ago at much lower rates than today's, the pressure of meeting soaring repayments has combined with a cost of living crisis and a gloomier outlook on inflation. Those three things together look pretty bad. But while borrowers face higher costs, the mortgage crunch has not yet translated into mass repossessions. So far, just 1,250 mortgage properties were taken in possession in the first 3 months of 2023. According to industry group UK Finance, this was 50% up on the previous quarter, but compared to the numbers that lost their homes during the recession that began in the 1990s, which was a historic peak of repossessions, and then following on for 2007, 2008, it's a drop in the ocean. In 1993 and 1991, 1993, some 188,600 homes were repossessed by lenders, according to UK Finance. Then again, in 2007 to 2012, the figure was very similar. The reasons for this apparent difference from now to then lie in mortgage trends, the history of house prices and hard-hitting regulatory reforms that have occurred. But they caution that there's still plenty of room for uncertainty given the unpredictable economic outlook, particularly over jobs. Well, I don't see that myself. Jobs are in short supply. If you look at the UK, there's very few places where people aren't looking for jobs. The immigration is running very high to try and fill that. The government sees it, and that is causing inflation. That's causing another problem. One of the industry specialists says, I don't think repossessions expect to rise to the extent they've seen over previous downturns. Neil Hudson, founder of the housing market analyst Gilt said, for lenders and regulators, they should be the absolute last thing they would do. And that's not to say we won't see them go up. We will, but it won't be as bad as it was. That's his quote. A surge in repossessions would pile further pressure on old Rishi. He's rejected calls for direct state support of mortgage holders, arguing that fighting against inflation was the best and most important way that we can keep costs and interest rates down for people. Although we did see some support being given out last week, really just, lip service, I think myself, not very much there at all. And I'm quite right too, if you get into trouble because you overborrowed, whose fault is it? The Bank of England's official interest rate is currently at 5%. It was in double figures between 88 and 91. As a result, most borrowers at that time chose a variable rate mortgage rather than fix at a high level. This meant, however, that rate changes hit their monthly payments more quickly, but also when they went down, it hit them quickly as well. So fixed rates are the norm now. While these will protect from interest rate changes for as long as their fixed lasts, they crucially provide borrowers with time to plan, which is the most important thing. you can plan ahead, you can speak to your lender, you can say I can't afford it, you can get an interest rate extension, you can go into interest only, all those sort of things, which is what the government was suggesting last week. In the early 1990s, when house prices dropped and it sent borrowers into negative equity, when the property is worth less than what you actually bought it for, or what the mortgage is valued at, banks and building societies face fewer regulatory responsibilities that oblige them to offer temporary help or alternative mortgage options. They do now have those controls in place. Repossessions have been rising but are well below the levels of 1990s, whereas many, as this diagram shows, many as 80,000 a year were occurring. Ray Bulger, analyst at John Charcoal, says there was no mortgage regulation in the 1990s. Lenders are now under the cosh from the Financial Conduct Authority to exercise forbearance and to go through all possible processes with clients to sort out some sort of tailored arrangement rather than repossess. And I think that is going to be crucial for a lot of people. I mean, I've seen some people being incredibly stupid. I saw a gent advertised, interviewed in the Telegraph in Oxford, who had borrowed £1 million to buy this £1.3 million property, and he was on a contractual employment basis. So why the lender gave it to him in the first place and why he thought he could deal with it is crazy. If you're sensible, this shouldn't be a problem for you. In March just gone, the FCA set out the measures it expected lenders to take to support struggling borrowers. Banks and building societies must offer existing customers a mortgage deal even when they fail other lenders' affordability tests. They must consider helping customers in difficulties cut their monthly payments, for example, switching from a repayment mortgage to an interest-only loan, or they should extend the term of their mortgage as another way of reducing payment. Some, but by no means all, lenders may offer a mortgage payment holiday. The government first unveiled a mortgage payment holiday for those affected during COVID-19 in March 2020, although such schemes have traditionally been used to help borrowers cope with short-term or unexpected changes in their circumstances. The problem is, though, doing this sort of thing increases the amount of interest you're likely to pay over the life of the loan, so it's not good for you. So obviously it's better not to get into that position, but the end is not nigh if you do get into that position, and you're not going to be repossessed if you speak to the bank. That's what it's all about. One banker said they were yet to see a material shift in the number of customers being unable to make mortgage repayments, but that the banks all were prepared. And he goes on to say, it's in no one's interest for a house to be foreclosed upon, and it isn't, obviously. The bank will take a year to do it. It's very painful for them. It's bad for their reputation. It's bad for the client. No one wins. As well as regulation, another key difference between then and now is the cushioning effect of housing equity built up over the years of house price growth. Research by estate agent Savills found that the total value of all the homes across the UK reached a record £8.679 billion at the end of 2022, with outstanding mortgage debt standing at £1.66 billion. So what's that? About 15%? 20% perhaps? In the 4 years since 2019, the value of UK housing stock has risen by almost a quarter, while the outstanding mortgage debt went up by just 11%. So whilst our outstanding mortgage increased by 168 billion, the growth in the total equity pot was well over 9 times that figure at 1.46 trillion, according to Lucian Cook, Savills' residential research director. For those with more equity in their property, with a loan-to-value ratio of 60 to 70%, but who are unable to make their repayments, this means they will have more meat to play with, more cushion to play with. So they've got more options and more time when agreeing a plan with banks. That's the real difference. Borrowers in this position are far from exceptional. Okay, last month, Lloyds Banking Group said its mortgage book carried an average loan to value of 42%. How about that? Average loan to value of 42%. Another safety valve not present in the previous crises is the stress test. where lenders assess whether a borrower can still afford a mortgage if the interest rates were to go up in the future. And I believe that level is actually 4%. So they added 4% to what they could afford now or then and worked out, would that work? Could they still afford it? Okay, each bank does have different criteria, and little of them follow up on the original assessment, to check if people are taking out more borrowing. It was unclear how much comfort policymakers can take from these tests, but it is a fact that 42%, is a very low figure, and stress testing at 4 times is a real comfort for the banks, especially when people have actually gone out and saved more money. Okay, Mr. Hudson again gave an example of a couple who take out their mortgage when they have 2 full-time incomes. If the latter decides to have children, one partner may earn only part-time, or one may go part-time, paying extra costs for children, blah, blah, blah. And that's going to mess up with their 4 times. Okay, for sure. They might also buy a boat. They could also buy Leeds United, any of those sort of things. So these things are going to change, but not everyone's going to do that. It's going to be a very small minority. As stress tests have risen, and are currently now up to 8%, according to Adrian Anderson, director of the broker Anderson Harris Lenders, they're also taking into account borrowers' other financial commitments, such as car loans and school fees, which have risen with inflation as well. So that's very good. They're taking into more lending to make sure they can afford it. Okay, Ms. Anderson goes on to say, this has brought out a few surprises over the past 3 months. Noting that under previous ultra-low interest rates, these extra payments would make little impact on the person's capacity to borrow. But we're now spending a lot more time checking affordability, he said, with different lenders. It's for the best, these things, because they are helping people be affordable. Hudson expected repossessions to increase and said that further dangers lurked. If the Bank of England has gone too far with raising interest rates, which it hasn't, I don't think, yet, and we start to see real impact on the wider economy, again, which we haven't, with job losses starting to occur, then that might be a situation where you have more repossessions. And that's true, but the labour market is so tight. I mean, the private sector labour market, on average, went up by 7% in pay increases. We may get into an inflation pay spiral, which is even worse, so we have to have higher interest rates. However, since the process is so lengthy, a lender must exhaust alternative avenues with a borrower before beginning a potentially drawn-out court process. The current low levels disguise what may lie ahead. A big rise in repossessions is unlikely as of the current data, but it may occur. The final alternatives to repossessions is just to sell up. Well, quite a lot of people wouldn't agree with that and don't think it's a good idea. Waiting to be forced out of their home by legal process comes with big costs and even worse, and will damage your credit rating. Better to take a hit and get out, especially if you have got a good equity build-up in your property. I know it's hard, and for many people, one of the most stressful things in their lives. For Hudson, the turbulence of the mortgage market and investors' single-minded focus on the next data release could have its upside. If the inflation news is better than expected, all of a sudden we can start to see rates come down again. I think, Mr. Hudson said, this is just a period of very volatile. And we need to remember that. Interest rates are currently at 5%. They may go to 6% and probably will. We just have to suck it up, see. And in 2 years' time, it'll be back down to 4% again, as the mortgage swaps are suggesting. Remember, in the UK, 33% of people rent, 30% own their properties for cash, and 30% have lending on them. Of that 30% with lending, the top 10% are those with minimum equity who will be in real trouble with mortgage rates going up. These are the things to bear in mind. It's not as stressed as it was. Don't listen to what's being said in the papers about the end is nigh. It isn't. Don't miss this buying opportunity, because it is a buying opportunity now. There's still some great markets out there. Okay, thank you very much. That's it for this week. Do take care, do share, and let other people see what you're reading. Do like and comment if you can. Thank you very much. Bye-bye.